would it be okay if we gave out a couple of gift cards to the most active chat participants? Say the three most active chat participants. Would that be fun?
I think that would be fine.
Okay.
And let me make sure this is okay with the group here. My understanding of Intel's HR policy is that this is okay. Does anybody have a different understanding of that? Okay. I think it's okay.
Okay. In that case,
I'm not sure, Daniel, whether this is okay or not with HR.
You think there might be a problem with that?
I don't know, but
okay.
I don't know. If we don't know, then we don't do it.
I know other groups have done.
Oh, okay.
That's good. Things.
That's good.
Yeah, I know we've done like random raffles.
Okay.
And certainly,
sounds like it's good.
I'll be ready to do either one there, Daniel. But I wanted to ask you guys first. Certainly, it'd be just a fun way for us to all contribute to the conversation. That's all. So you let me know.
There's a dollar limit of $35.
That's good to know.
Where did you find that HR rule? Because I've scoured Intel's internal network for HR rules, and I haven't seen that.
There's a policy called Get Met, gifts and entertainment and merchandise, something like that. I'll see if I can find it and send it to you.
I'll look for it too. Thank you.
Mm-hmm. Thank you very much. And like I say, I looked at the kind of the outline you gave me, Daniel, of all the rules for today, and wanted to make sure that was doable. But I thought it'd also be just a great way to say thank you guys, and also help us all stay engaged on a Friday afternoon. So what maybe we can do in that regard, Daniel, if the three most active people, if you notice them on chat, just their information. I won't ask, of course, but if you just want to tell me how I can get that to them, I'll make sure to do that.
Yeah, I will. I'm not allowed to give you their names, but what I can do is contact them and ask them to contact you.
That's great. That's perfect then. That's exactly the right way to go. Thank you very much. Okay, well, hopefully that helps. I'm going to set a timer here too, so I can keep an eye on time. I've got about 35 minutes if I remember right. And then hopefully that leaves us a little bit of time for questions.
We're going till 1 o'clock. So however you want to use the time.
Okay, got it. So that's to the top of this hour. Okay, great. Well, let's get it right on into it. I have a feeling that there are a number of different applications for the real estate space on this group. This is a wonderfully engaged group already, I can tell. I'm so happy, Daniel. Thank you for the opportunity to speak to everyone who can benefit from today's workshop. I think anyone involved in real estate at this level, land flippers, wholesalers, property flippers, landlords, syndicators, fund managers, dabblers, even just someone just dabbling in the real estate space, I think is going to find some value in what we're going to be discussing together today. Specifically, what I hope to help point us toward today are 3 specific strategies and tactics for becoming your own banker. We just talked about the world of banking and cash out refis today. But I'd like to suggest that becoming your own source of financing might just be the most overlooked point in most people's real estate portfolio, and even more so, the whole of your life, all of the financing that we need in life. So if you stay to the end, I'm going to be sharing a way on how you can implement these creative uses for your real estate business. I do plan to show both concept and mindset, but right down to some tactics and spreadsheets and more. So I think that'll be hopefully a helpful kind of a teaser for that. Again, my name is Mark Willis. I'm a certified financial planner. I have a firm the firm is Lake Growth Financial Services. I'm a 3-time #1 Amazon bestselling author. I co-authored a book recently, Real Estate Investing for Women. I'm not sure how they invited me to get in that wonderful book, but I was really honored to be a part of that. And I specialize in building specific, little-known financial strategies that are custom designed for real estate investors like yourselves. I co-host the podcast, Not Your Average Financial Podcast. I share strategies on investing in real estate, saving and paying for college without going broke, and creating an income in retirement you cannot outlive. So I think some of the strategies that have become sort of our bread and butter and our mainstay at Lake Growth Financial Services are not typically talked about by financial gurus on the radio or most investment advisors. And I've found them to be more tax efficient and to help bring back some control to your financial future, to help with your real estate business, and more to the point, your financial life. So let's just jump right on into it. This is my contact information. I just wanted to let you know that's probably the best way if you'd like to reach out to me. I do a 15-minute phone introduction. So if you cannot stay to the end, that's the link to go to. So it's just bit.ly/boyrealestate. Boy Real Estate. So I already have a pop quiz, and Daniel, you'll have to tell me. Let's see if I can find the chat again here. I think I can find it. The pop quiz is, who said this quote? A banker is a fellow who will lend you his umbrella when the sun is shining, but wants it back the minute it begins to rain. Who said the quote? Anybody want to put in the chat their best guess?
Somebody has said Twain.
Twain. Okay, we got B, C.
B, C.
Yeah. JP Morgan. That'd be great if JP Morgan said it. Yeah. Wow, we got a lot of responses here. The first person to get it right was who was that? It's Mark Twain. So whoever put B, it's the chat is going faster. Reyes looks like, or Bob Bach, it looks like.
It was that, yeah, Reyes.
Awesome. Well, congratulations. You were right. Mark Twain, a great quote, and oh so true. A banker is a fellow who lends you his umbrella when the sun shines, but wants it back as soon as it starts to rain. Now, if you've attended any real estate workshops or events like this in the past, you know quite a bit about this. Now, obviously, an Employee Benefit Research Institute study recently came out and said that 1 in 5 survey participants had loans against their 401ks. And they used that money, according to the survey, to pay off credit card debt, mortgage payments, or other bills. Another point in the study was that 34% of people in their 50s took money against their retirement plan in a recent year, and more than 60% of Americans have less than $25,000 set aside for their retirement. Guys, that's more than 60%. And in fact, a recent Federal Reserve study revealed that the average American would need to sell something or go into debt if they had an emergency of just $400. $400. But guys, I don't need to even say these stats, do I? We all know many folks who are just struggling to get by. There's a problem in our country, and it seems to be a three-pronged problem, a problem of debt, speculation, and lifestyle. And those three pieces of the puzzle seem to fit together in my mind anyway. We chase things and buy things we can't afford to impress people we don't even like with money we don't even have. And so because we don't have enough money left over, we have to speculate to get a higher and higher rate of return. In fact, in 1940, you guys can see here the average dollar, according to the U.S. Commerce Bureau, 11% of our dollars went to debt, 15 to taxes, 47 to lifestyle. And back in 1940, we saved 27% of our income went to savings. Now, fast forward to this most recent year, 35.9% to debt and only 5.4% to savings. Isn't that interesting that we almost flipped from being a saving nation to a in-debt nation? I just think that's very interesting. So what happened there? Again, I think as we chased higher and higher lifestyles, we had to start saying something like this. And this is what I hear a lot of folks say when they come into our office, or increasingly these days, if we're having a meeting over Teams or over Zoom or over Skype, whatever, we're having conversations that sounds like this. Mark, I can't save that much. I can't save 27% of my income. I'm just going to have to put more at risk and hope that my rate of return will be higher. And hence, that's been the kind of the reality of things for the last 50 years or so. That's the invention of the IRA in the 1970s, and the 401k was invented in the 1980s. And things like 529 plans, day trading, mutual funds, 403bs, it's all the same. You know, we're now too sophisticated to merely save, so we put more and more into investments. So, you know, most financial plans that I've found are spinning their wheels. You know, Wall Street on average, and this was a shocker for me, Wall Street on average has lost 14% every year, at least temporarily throughout the course of the year, every single year. And a bear market on average is a 34% decline, which happens every 3 to 5 years. Now, if 14% of your money in your wallet was being stolen on the train on the ride to work every day, would you find a way to keep that from happening? You know, the problem with losing 14% every year and 34% every 3 to 5 years is that you have to earn a lot more than that just to break even. That's how the math works out. You know, most people think, well, hey, if I lose 14%, I just need to get 14% returns in the market to break even. Well, unfortunately, that's not the case. Case in point, let's say if you lost 50% of your money, you cannot just grow your nest egg by 50% to break even. You know, let's say you had $100 to start. Let's say you lost $50. If you grow your money by 50%, that's only $75. You don't have the $100 yet until you've doubled that $50 back to 100. So the problem is the bad years hurt more than the good years help. And that's what we call the sequence of returns, which we don't have enough time right now to get into. If we have time toward the end, I'd be happy to share more about that. But, you know, suffice it to say, those bad years in the market hurt us more than the good years help us. So how do we fix it? Well, of course, the answer to many folks on this workshop today is keep calm and invest in real estate. Of course, right? But there are some significant hurdles to real estate. You know, does the math really add up? Have you ever done the math on that? Appreciation of property, at least lately until last year, has hardly kept up with inflation. And of course, we had someone could probably give me the more accurate quote, but my mind is saying we've had over a 20% appreciation on most properties in most markets over the last year. But even with the 2008 crash notwithstanding, home values in the US have outpaced inflation by only a measly 1% per year. 1% above inflation, according to Robert Shiller. And you know how many would tell us to do real estate investing with our self-directed IRAs. But does it sound like a sweet deal to earn a whopping inflation-adjusted 1% in our self-directed IRA? Not me. And of course, don't forget that at least some of that juicy 1% is going to get taken by Uncle Sam when it's time for retirement out of that self-directed IRA. And don't forget, there's a lot of times that tenants are not paying us rent, especially these days, in the last years, 18 months or so. And it's costly to buy, sell, and maintain. Now, there's some other hurdles. You know, I've kind of asked some folks, you know, what is it that we truly love about real estate? Well, for me, I love the feeling of seeing the property, going to that apartment complex that I know I have in a syndication or have in my portfolio, and putting my hand on the bricks, feeling the drywall, knowing that it's a tangible, real asset. But here's a kind of a stark question. Am I truly in control of that asset? No. Really, without the contract in my hand, you know, the contract to that property, all I actually have is squatter's rights, don't I? You know, without a contract, I'm without really any recourse. All I have is squatter's rights. And am I in control of my equity in my house? No, I need a bank, don't I? I need a bank to access equity in my home. We were talking before we started here about refis, and you know, on cash out refinances, for example, we need a generous bank to give us our own equity. And meanwhile, many people are underwater on their personal residence and their investment properties. Speaking of non-paying tenants, I heard a landlord actually was homeless because they couldn't live in their own home because the tenants were not paying them rent. So there's nothing guaranteed about our home value or our investment values, if we're honest about it, right? So I have a question. You know, real estate doesn't insulate us from crisis. Remember that Mark Twain quote about a banker in his umbrella. When are you most likely going to need capital? Well, during a crisis. When are banks least likely going to give us capital? During a crisis. When will it be hardest to sell our property for a fair price? You guessed it. During a crisis. Now, to me, it's important as a certified financial planner to take a step back and to just start thinking about first order consequences and second order consequences. Where I keep my money and where you keep your money will make it do different things. A savings account is different than a hedge fund, which is different than an annuity, which is different than a 401k, which is different than a rental property. Our money acts different depending on what bucket we put it in. So really a key question here for me is, what do I truly want my money to do for me? If you get nothing else out of this presentation today, bring that question back to your journal or wherever you do your reflection and ask yourself that question. What do you truly want your money doing for you? What does it look like when you are the boss of your money? Think about that for a moment. Maybe write some stuff down. Put it in the chat. What are some characteristics in the chat? Just take a moment and just think about what are some of the characteristics or attributes you want your money to have. If you could wave a magic wand, if you could be Pope of money for the day, what sort of attributes or characteristics would you want it to have? And while you're doing that, I'll give you some food for thought. Like a fish out of water, if you put your money in different environments, it's going to act different. So a fish in the wrong environment is dead, right? If you put a fish on the sidewalk, it's not going to last too long. But if you put a fish in a well nurtured, fresh water, it's going to thrive. It's going to reproduce. There's going to be all sorts of little baby fishies floating around. But most financial environments take control away from you. Think of Wall Street, 401ks and IRAs, banks, credit cards, finance companies, real estate inventory, heck, even a shoebox. Most financial environments take the control away from you. So again, my question, if you could design the perfect financial instrument for real estate investing and ultimately for retirement, what attributes or characteristics would you guys consider to be important? Let's imagine you're Jerome Powell or Janet Yellen or someone, you're Pope of money or something like that. Let's say you have absolute power to change the tax code, the banking system. You can create one perfect financial vehicle. What would you guys want it to be? Shout it out, put it in the chat. What would you like it to do? Generate passive income, I see here. No fear of running out of money. Pay me. Store of value. Get 10%. Compound growth. These are great. Anybody have any other thoughts? Safety. Provide for every need of my family when we need it. Guys, these are great. Be able to generate income, both passive and active. Non-taxable. Amen. Tax-free access when I need it. Wow. This sounds familiar. I'm going to share my screen now, and you guys just tell me if any of these resonate with you. This was my own little list as I kind of jotted my own thoughts down. I wanted easy access to cash, liquid access to funds in an emergency. I wanted it to be safe, something that was highly rated. I didn't want Bernie Madoff handling my cash. Sorry, Bernie. I wanted it to be third-party rated. I wanted some guarantees that the money was going to be there, so I didn't lose it just because the market was tanking. I also wanted it to be a good, competitive, long-term, beating inflation rate of return. And I wanted it to be non-taxable every year. Could I do that? Is any of this even legal? I'm not sure. I'm just making my wish list right now. Tax-free access to cash. I wanted it to both be principal and gains accessible with no taxes due. I wanted no contribution limits. I wanted it to be like an unlimited Roth IRA. I didn't want it to be phasing me out if I made too much income. And I didn't want it to be limited by how much I could contribute to it. I wanted it to be flexible for real estate or for my family or business or whatever. I wanted it to be tax-free to my family. And I wanted it to be, especially in real estate, privately owned. I wanted it to be outside of lawsuits or creditors or predators. That's going to be huge as we enter into a post-COVID world where I believe, unfortunately for us in the real estate space, lawsuits are going to abound. So what if you could see your money grow at a faster rate every year, no matter what? What if you could keep your money accessible and available to you for your real estate business? What if you had a plan, not just for this year's real estate needs, your property tax or your new heater that needs to be installed or whatever, but every year, the next year, the next year? And guys, what if you owned and controlled the outcome of your financial strategy before you even started? These are my questions that I ask, like, why is it we can't ask this question? Shouldn't this be the default for the start of our financial plan? Most people think when they look at that big list that I showed here, that this can't possibly exist. There's nowhere in the financial, you'd need 24 financial vehicles and a complicated trust to manage it all, just to do what I just listed there. But in my view, there is a place where we can keep some of our cash for real estate needs. And as a certified financial planner, I studied it. I looked all over the place. 450 financial vehicles and strategies that I researched before coming across, of all things, a dividend paying whole life insurance policy. In my view, no financial vehicle works better for real estate or for my family than a massively maximized and modernized dividend paying whole life insurance policy, otherwise known as a high cash value dividend paying whole life insurance policy. I'm going to refer to this as a bank on yourself designed policy because it's just easier to say. Quite honestly, that's quite a mouthful there. So let me show you why. And for me, the more I studied this, the more I could not turn away from this unique and mostly forgotten financial vehicle. It's been around for centuries. It's been around over 200 years in this country. But it's not the kind of whole life insurance that Dave Ramsey talks about or Susie Orman loves to hate. These are specifically designed, and typically we are cutting the commissions on the policies by about 50 to 70%, and the insurance expenses are cut as well to allow us to have a ton more wealth building up in the policy. So again, why dividend paying whole life insurance? Well, it does a few things really well. It's increasing in value on a guaranteed basis for centuries. It has a better return than most of our other cash equivalents in our portfolio. I mean, guys, it's doing more than 5 times what my CD could do or my money market account could do, but with similar liquidity. In fact, better liquidity, because I can get access to the cash in about 3 to 5 business days. There's no piles of paperwork. I don't have to get access to money with a long, laborious loan request. And it allows me to have more time to run my business or to focus on my family or to focus on my real estate, not have to beg or borrow from a bank. It allows me to become my own source of financing. I get to decide my amortization schedule. I get the freedom of repaying myself at whatever pace I wish. And of course, it is life insurance, so it's going to leave my family more than I could ever save for them. Okay, so we're doing this through something called the paid up additions rider. And that's the specific rider or option. It's like an automatic window on your car is an option. You can put a sunroof on your car. It's an option. It's essentially a way to customize the life insurance contract. So using a paid up additions rider, if you want cash, you get cash. And by putting a paid up additions rider on a whole life policy, there's typically about 40 times more cash value, especially in the early years, than the old fashioned whole life insurance that I've seen. So that's an extreme cost reduction through that rider and other similar riders that help us accelerate cash value growth. Again, 40 times more cash value in the early years of the policy means we can start using it as a cash management tool right from the start. Okay, so again, you do control the cash in this policy. These are unilateral private contracts with the insurance company that you have a policy with. The insurance company cannot change the rules on you without your consent. The government cannot put limits on how much you can put into an insurance policy. That's crucial. So we've got folks putting a couple $100 a month into one of these and other clients that are putting a couple $100,000 a year into these policies. Again, there's no government limits on what you can put into a policy. There's no penalties. There's no early withdrawal access to the cash. Unlike a 401k or an IRA, there's no early withdrawal penalties. While we're talking about it, there's no required minimum distributions. The government will not force you to take the money out just because you have a certain number of candles on your birthday cake. And this is huge in relation to self-directed IRAs. With life insurance, there are no prohibited transactions. So I can fix up my rental property with my policy's cash, and I could just as easily fix up my kitchen or go to Disney World or send my kid to college. So there's no red tape when it comes to getting access to my cash. Now, I want to quickly mention, just because you might have a couple extra candles on the cake, don't count yourself out. Even if you've got some health concerns, you don't have to be the insured on whole life insurance. You can own the policy, but it might insure somebody else. Maybe it's your spouse. Maybe it's one of your children. Maybe it's a business partner, someone else in your real estate LLC. And if you're not sure you can fund a policy, talk with me. I'd be happy to chat with you about that. It'd be pretty common for clients that I meet with to sit down. We'll have a 50, 90-minute conversation and get a good sense of what that debt layout looks like, what your assets look like, and see if this strategy is even a good fit. Not sure it is for each person on the call, of course, but it's worth looking into. In fact, let me tell you a story. This is Dan. He's out in Boston. He was willing to share his actual net worth statement. He had done everything right. He had done kind of the 401k, IRA, contributions. He'd gone through the rise and fall of the tech bubble. He'd gone through the recovery phase of 2003 to 2006. He got slammed in 2008, once again there. And as you can see, he started something there toward the end of 2009 when he opened up his very first policy in June of 2009. Look at what happened to his actual net worth. This is straight off of Quicken. Notice that real wealth beginning to build and grow. His net worth nearly tripled in just 10 years. Instead of just rolling the dice with Wall Street, now he's using his whole life policy to buy and borrow and accelerate his net worth through real estate investing and borrowing against his policy to do so. And I want to get to exactly what that means. So let me kind of talk about this. Again, this is not for everybody. It is a nuanced strategy. It does take some learning. I do actually require anyone I work with to pass a pop quiz before they can work with me. That's kind of just, I think, important that you guys understand that we typically have some homework for folks before they work with us about on this strategy. I also say it's not overnight wealth. You're not going to get rich with 30% rate of return on these policies, especially not in the first few years. It's going to be a steady, boring, middle single-digit returns, 4, 5, 6%. And don't do this if you can't save. I would suggest, looking over your cash flow before you start something like this, if you can't save right now. Let me talk to you about what I see as kind of the general way most people buy things. So I want to kind of turn our attention to the normal way to do things, as I call it, the oh-so-average way to do things.
Hey, Mark, would you like to take some questions now, or
sure.
save them till a little later? However you want to do it.
Sure. No problem.
I just noticed I hadn't looked at it in a few minutes, and the questions are piling up. So the first question, it comes from Ruben, and he's asking, is this a dividend-paying whole life insurance?
It is. This tool is using a dividend-paying whole life insurance contract.
Aha. Ryan Lee is asking, is this the same concept as infinite banking?
Well, let me say this. There are a lot of infinite banking advisors out there, but there is no regulation on the words infinite banking. So it's not unlike natural peanut butter. You really want to find a bank on yourself designed policy. That is the only credentialed training program in the country, or Canada, by the way. So the United States or Canada. It's more of the USDA organic, if that makes sense. So it's similar, but there are some key differences. In fact, I've found 30 characteristics that you really need your policy to have to be truly a bank on yourself designed policy. So it is categorically similar to infinite banking, but I'd count it as categorically different in some of the ways I just mentioned.
All right. We have some questions that I think you may answer here. One is really short and to the point. What's the catch?
Yeah, great question. Yeah. Like I said on that previous slide, it's not for everybody. This will take time. It's not overnight wealth. So don't think of this as a get in, get out strategy,
Just
I don't know if
out
that
of
helps.
curiosity, do you have to pass a physical for the life insurance?
If you're the insured, but like I say, you don't have to necessarily be the insured to own these policies. I had a guy who had a open heart surgery right before I met him. Thank God he made it through the surgery, but that kind of put him on the, no-fly list for life insurance for some number of years. But that didn't stop him. He had a wife and adult children and grandchildren. He owns 12 policies on all of his family members. He uses it for real estate. He's got several rental properties he uses those policies for. And guess what? Every Thanksgiving, he's sharing his annual statements with all the kids and grandkids. And one day when he passes away, a long time from now, I hope, that is part of the gift he's leaving for the kids and family.
All right. James has a good question here. Are you dependent on the financial stability of the insurance company?
Yes. So you don't want to just work with any insurance company. There's probably 1,100 life insurance companies at last I checked. I wouldn't do business with 98% of them for this concept.
I'm going to ask a follow-up question to that. And I honestly don't know. Is there a secondary market to life insurance where the person you originally create your policy with resells it to another, just like with mortgages? There
Yes.
is. Okay.
Yeah.
So with that, that would affect knowing the financial stability of the policyholder or of the company that's backing the policy.
Correct.
Okay.
Yeah. Good question.
There are several questions asking to go over the tax consequences, and I'm trying to go through and summarize here. I'll let you continue on, and I'll keep reading.
Yeah, take note. Those are all great questions so far. I'll keep moving so we can get to some real numbers too. I bet you there's at least a few folks that would like to see that. So when we usually buy something, I want you to think about the ways we buy something basic, like a car. Let's just say we're going to buy a car. What are the ways we can buy a car? Let's imagine this line on the screen is net worth of 0. Okay. And if we have nothing saved, how do we buy a car this afternoon? Well, we go into debt. So now we are below net 0. And what happens 30 days later? Well, we start making monthly payments. This could be a mortgage, it could be a student loan, it could be a car loan, or all of those at the same time. What happens is we get to the flat line again and we scream, I'm debt free. We call Dave Ramsey and give him a shout. But what happens? Our car is now 5 years old. Kids are kicking the back seat. And what do? We go back into debt to get our new shiny car. And we repeat that process over and over and over again. That is the debt staircase. And most people live their entire life on the debt staircase. So what's the other alternative? Well, we ride shotgun for a few years, right? We save up. We don't buy the car. We delay the consumption. We save up and we put it into a savings account or somewhere like that. And then we ultimately walk into the car lot and we withdraw the money out of our bank. We write the check and we pay cash for the car. And what do? We fall down the staircase back down to net 0. And we only start earning interest again slowly as we save up for the next car. This is eerily similar to the debt staircase. It's the mirror image. In both cases, we continuously break compound growth. Now, some people might say that beats paying interest to a bank, but I would actually say I would rather be an honest borrower at someone else's bank than to pay cash for things and steal from my future. And that's the truth. Every time I pay cash for something, I am stealing from my future self. I did the math, and I don't want to get into too much detail on the time we have left here, but if you just save $350 a month into an interest-bearing account, 5% a year for the rest of your life, you'd have about $900,000. But most of us save up $350 a month to save up for our next car, and we have nothing to show for it at the end of our life except a bunch of old cars. So how can we overcome the problem of opportunity cost? How can we lift off from 0? Well, when we have a dividend-paying whole life insurance policy, and if it's a true bank on yourself type policy, not all whole life insurance does this, it will have what's called a non-direct recognition loan. And what that means is when I borrow against my life insurance policy, it will continue to compound and grow as if I hadn't touched the money. Let me say that again, because that's huge. If I have $100,000 of cash value in my life insurance policy, and let's say I borrow out $30,000 to buy a car, my policy that year will continue to earn interest and dividends on the entire $100,000 as if I hadn't touched a dime of the money. Now, to me, that beats paying cash. In fact, it beats any other major way I can think of to buy major purchases, whether it's a car or my kid's college or real estate. In fact, I would say it's not a decision between whole life insurance and real estate. It's not either or, it's both and. When you have a whole life insurance designed the bank on yourself way whole life insurance policy, it's like combining real estate with whole life insurance can be sort of like combining nitrogen and glycerin. they're better together. It's like peanut butter and jelly. It's like Batman and Robin. They work better together. So here it is in 4 simple steps. Build up enough money in your whole life insurance policy to purchase some real estate. Step 2, the policy will continue to grow even on the capital you borrow, giving you 2 assets rather than just 1. Step 3, you fired your banker, so now you control the repayment schedule to the policy that you own. If the tenant stops paying you, you can stop repaying the policy. And no one's going to come repo the car or repo the house or whatever. It's your policy. You are the banker. And step 4, when you ultimately sell your policy or your property someday in the future, you can simply recycle the money right back into your policy. Simple. All right. I'm going to get into like a couple of examples here. So you could use this for simple things. Start with simple stuff. You can use this to pay your property taxes, your homeowner's insurance. What about your HOA specials if you have them? How about repair and maintenance? Anything that you might pay cash for, even the down payment, you can overcome opportunity cost. Now remember, guys, this is not a get rich overnight strategy, so you might start out small with smaller things like homeowners insurance, etc. Any kind of annual annoying expense can be a great place to use this policy. So again, here's the first strategy here. You can borrow from the policy and pay cash at closing. 2, you can increase your yield without any additional market risk. Think about that. If the policy is doing 4 or 5 or 6% by itself, and let's say your real estate does another 4 or 5%, don't you get some arbitrage there? Don't you increase the return on the real estate without any additional market risk? And oh, by the way, didn't you create a permanent line of credit? No banker can take that away from you. That is your wealth, no matter what happens. And when the next recession comes, not if, you will be the one sitting on a boatload of cash ready to pick up properties on the cheap. Okay, so I promised some numbers. Let me get to them, and then we'll wrap up with some questions. So here is a real life policy. Here's somebody who's 35 years old, and this person said, hey, you know what? I can set aside $1,500 a month. Now pay less attention to the exact number of what this person could set aside or even their age. The cash value would be proportional to how much you put in, regardless of your age. So in the first year, he's put in 18 grand. He's got $11,000 of cash value in the first year and a $648,000 death benefit. By year 3, he's got 40 grand. Now notice he has no loans on this policy ever. And if we go all the way down the page here, at age 70, he's got $1.2 million of cash in his policy. And I don't know if you can tell there, but he starts to take a tax-free income of $60,000 a year. All right. Now keep that $1.2 million number in your mind for just a moment, because what I'm going to do next might shock you. It shocks me. So here's the exact same person taking out the same exact policy, but now starting in the 4th year, he's going to start borrowing $35,000 to go put into a real estate down payment, 35 grand. And he repays that loan over the next 5 years on his schedule, recall. And he does that 6 times over his lifetime. He pays off the loan, and by age 70, his cash value is, wait a minute, where have I seen that number before? $1.2 million. That's the exact same number he would have had he never touched the money, if he had just left it sitting in his policy. So he simply used the policy as collateral for the loan. It's not unlike a HELOC, if you're familiar with that, except with way more guarantees than a HELOC offers us. So as we kind of wrap up, I can either go into 1 or 2 other strategies, or if we're getting blown up on questions, Daniel, I'd be happy to stop here.
There's a lot of questions. In fact, I don't think we can get to all of them.
Okay. Maybe I should just
they go in a lot of different directions too.
Sure. Well, then let me skip over all this, and I'll go kind of to where you can reach me, and I'll leave that up on the page while we answer questions.
Okay. So let's start with how would you compare this strategy to a HELOC or a security-backed line of credit?
Well, that's perfect timing. I was just talking about that. Yeah. How is this like a HELOC. Well, let's say our house is worth 200 grand. Let's say Zillow tells me my house is worth 200 grand for simple math. Let's say I've got a $100,000 HELOC on my house. If I borrowed out 100 grand against my HELOC, does my house stop growing? No, it continues to compound and grow whatever Zillow tells me it's worth on all $200,000. Now, there's nothing guaranteed about my HELOC, and there's nothing guaranteed about my home value, right? See reference 2008. People had their HELOCs frozen or slashed, and they also had their home values slashed. So a whole life policy, I can have $200,000 in my whole life cash value. And if I borrow out a loan against my life insurance at $100,000, let's say, again, just like the HELOC, my policy will continue to compound and grow on all $200,000. Unlike a house, though, my policy grows guaranteed. And unlike a HELOC, my loan is guaranteed as well. In other words, the right to loan against my policy is written right into my contract, and they can't take that away. So that's a key difference there.
All right. Another question. Are you using after-tax dollars to contribute to the plan or pre-tax dollars?
Yeah, great question. 99% of the time, these are after-tax dollars, just like a Roth IRA. So in fact, life insurance is similarly taxed to a Roth IRA. You're putting money in, paid your taxes on it, and then it stays in the policy and never gets taxed again. Tax law says cash value does not get taxed while it's in the policy. And if we design the policy correctly, you can get principal and gains out of this policy with no taxes due.
All right. Next question. Is your policy insured like a bank balance?
Oh, well, that brings up a great question as to how much value do I put on FDIC insurance. I personally don't have a lot of faith that FDIC has much in the way of their deposits. In fact, the most recent stat from their own bookkeeping says that the FDIC only has 1% of our deposits on reserve. 1%. 1%. So no, life insurance does not have an FDIC insurance. And to me, that's a good piece of good news, because life insurance companies cannot inflate the money supply like banks can. If I put 10 grand into my savings account at the bank, how much of that $10,000 do you think the bank keeps in the vault? Almost none of it. In fact, less than 10% of my money is still in the vault, so to speak. The other 90% of my money has been loaned out to the guy behind me in line needing a loan. So the regulatory body for life insurance is FINRA and the State Department of Insurance, wherever you might live. And they are regularly auditing insurance companies to make sure that the insurance companies are not doing that funny business of fractional reserve banking or inflating the money supply. So life insurance companies must keep more than 100% of our deposits. It's actually 114% of our deposits must be kept in reserve for the eventuality of our passing. So that's probably too long of an answer there, Daniel, but it's at least 10 times as safe as a bank, according to those numbers.
By the way, I'm glad I was on mute when you mentioned the phrase "Pope of money," because I broke up laughing when you said that. Okay, let's see here. This is a great question. What are the risks involved?
That's a really great question. There's no free lunch except the cheese at the end of a mousetrap. That's my personal belief. So the risks are, in the first years, we lose some purchasing power, right? Let me go back to that, and I'll try to keep this brief. Take a look at this guy's cash value in the first year. He put in $18,000. How much cash value did he have? Well, he had $11,000. Now that's way more than old-fashioned life insurance, where they might give you $100 or something in the first year of cash value. But it still lost some money, right? We lost some purchasing power. That might be considered I don't know if that's a risk or more just of a consideration and cost. That would be the biggest, I'd say, consideration when you're looking into this strategy. Don't do this for overnight wealth. I think I've said that 3 times now, but this is not a get rich overnight type scenario, this is a lifetime of wealth. If you did the math on how much he put into this policy, I think it's $480,000 over his lifetime. Over this guy's lifetime, $480,000 is my mental math. I hope I'm doing that right. But he's got 1.2 million in total cash over his retirement, or ready to go for his retirement. So you certainly lose some money in the first few years, according to the insurance expenses, but you end up with a profit many times over your contributions, ready to go for retirement.
Nope. Now, Mark, we're coming up to the top of the hour. Can you make sure to put your contact information up there so that people can get in touch with you? And there are so many good questions here, and we're not going to get to all of them. This one, I'm not sure. I think this is a good question, but it's one that I don't know the answer to. So, when you say no government control limit is put into, what of MEC limits or MEC limits that are caused? That cause overflow to become taxable.
Somebody has already done the research. I'm really impressed with this crowd. This is awesome. There are no government limits for what you can decide you want to put into a policy. That's very different than a Roth IRA or 401k, where the government tells you can't put more than $6,000 a year in if you're under age 50 into a Roth IRA. That is the limit of a Roth IRA contribution in this year, 2021. Again, I have clients that are putting in $6,000 a year into a policy. I've got others, wonderful, wonderful people who are putting in $600,000 a year into a life insurance policy. Now, that's not to say anything other than the government does not restrict us by what we put into the policy. Now, you're bringing up the MEC limit, which is absolutely something that the government does have a look at. And at the end of the hour, I probably don't have time to get into all the details. But if you've designed the policy correctly, again, back to make sure you're working with a bank on yourself professional, whether you work with me or somebody else, ask them if they're a bank on yourself professional and insist on that, because there's only 200 bank on yourself professionals in the United States and Canada that can design this correctly to avoid any tax implications like MEC.
And one last quick question. Is there an upper limit to the repayment schedule?
Could you give me any other context to that one, Daniel?
I think what they're asking is since you're borrowing from yourself, is there a limit on how long you can not repay your own loan?
Yeah, great. Okay, well, and I'll say you can always borrow 90% of your cash value. So that's one upper limit. So it's a 90% loan to value. And then it might be you take your entire life to pay back this loan. You could take 1 year, 2 years, 10 years. If you never pay off the loan, it'll simply be deducted from your death benefit when you pass away. That's why they have no required repayment plan. It's already been factored in.
We're at the top of the hour. Can everybody take themselves off mute and thank Mark for coming in and speaking to us?
Thanks, Mark.
Thank you, Mark. Great presentation.
Thank you.
Thank you.
Thanks, Mark.
Thank you, everyone. Thank you very much.
Thanks, Mark.
All right. And Mark, with your permission, I will post the recording to our internal website along with your contact information.
Well, thank you.
Yep, absolutely. Have a wonderful weekend, everyone.
Thanks, Mark.
Thank you.
Thank you, everybody. Have a good day.
Thanks, Daniel, everyone.